Every second, an unimaginable volume of goods moves across the ocean. Cargo ships, freight trains, and planes feed domestic consumption at a relentless pace. Many countries consistently buy billions of dollars more from the rest of the world than they manage to sell. Year after year, the shipments arriving dwarf the shipments leaving. If a nation is constantly spending cash to purchase foreign goods at this scale, why doesn't it go completely bankrupt? The answer lies in the balance of payments. This is the master macroeconomic ledger that records every single economic transaction between one country and the rest of the world. This ledger acts as a self-correcting system, using a specific mechanical process that forces the global economy back toward equilibrium. This system relies on two main sections, starting with the current account. It calculates the short-term flow of all goods and services. This includes visible trade, physical items like electronics crossing borders, and invisible trade, which captures services like international banking and tourism. When a country imports more visible and invisible items than it exports, it creates a trade deficit, a financial hole that requires a specific source of funding. The current account reveals the immediate imbalances a nation faces by tracking exactly what it is consuming right now. The ledger's second half is the capital account, recording long-term international capital transactions. It groups these into categories like foreign direct investment and portfolio investment. If an overseas firm buys a domestic plant, that cash enters here as an inflow. This leads to the golden rule of global macroeconomics. For the system to balance, a deficit in the current account must be met by a net inflow of capital from overseas. Dollars sent abroad for a foreign car eventually flow back home as foreign investment in domestic government bonds or real estate. The expenditure leaving one side of the ledger returns as an investment on the other. A trade deficit represents a mechanical swap, where a nation trades immediate consumption for the sale of domestic assets to the global market. If these accounts drift too far apart, the exchange rate acts as a natural shock absorber. A fall in currency value makes exports more competitive and imports more expensive, driving an improvement in the current account balance. Conversely, an appreciating currency lowers inflation but makes exports more expensive, leading to a drop in goods leaving the country. Economists call the theoretical equilibrium point purchasing power parity. Over the long run, market forces adjust exchange rates until a standard basket of goods costs roughly the same in every country. Currency fluctuation serves as the regulator that pushes a wandering ledger back toward a stable balance. These corrections take time. There are significant lags between a change in currency value and its actual impact on the trade balance. Because consumers take time to adjust spending habits, a falling currency creates the J-curve effect. The trade balance often gets worse before it eventually improves. This chart plots that process. The initial dip at the bottom of the J occurs because the price of imported goods spikes instantly, while consumers are still locked into their existing buying patterns. Eventually, habits shift. Foreign buyers increase their demand for now cheaper exports, and the line sweeps upward, moving the ledger back into a surplus position. The completed balance of payments ledger shows how trade, capital, and currency function together as a single integrated machine. In a globalized economy, a trade deficit is part of an intricate ecosystem. It is a continuous, quiet balancing act where today's consumption is financed by tomorrow's assets.